Hello class, this is Dr. Fenton. In this video I'd like to explain adjusting entries. Now adjusting entries are used at the end of an accounting period to bring quite a few of the accounts up to date. First of all, the end of an accounting period, what that means is at most it's a year. You have to do this at least once a year for your businesses, but some companies will produce statements every quarter, every 3 months, and some might even do it monthly. Now I doubt if they'll really go through many adjusting entries every month, but they will at the end of the quarter, if they have to prepare, formal financial statements that are, the quarterly results that they present to the public. But at least once a year, it has to be done. The accounts that are affected are, like I said, any number of accounts, but there are a couple of accounts that are never adjusted with these specific adjusting entries. For example, the cash account is never adjusted. Neither is the retained earnings account. And for that matter, the common stock account is never adjusted either. Now those accounts will change during the year with regular journal entries. Well, the retained earnings account really will not change usually during the year. Rarely does it happen. It will change at the end of the year with what are called closing entries, where you actually close or enter the net income account, the net income number, into the retained earnings account to bring the retained earnings account up to date. And also dividends will reduce retained earnings. So let's get to it. Let me bring up the spreadsheet. Here it is. And you can see an example I already have down for an adjusting entry. So if you're given the fact that depreciation that needs to be recorded on equipment, for example, is $5,000, this is the entry you would make. You would debit depreciation expense and you would credit accumulated depreciation. Now the debit credit rule for depreciation expense is it increases with a debit, and accumulated depreciation, which I see now I have it misspelled. Let me see, let me take this O out. I think that's better. Accumulated, there you go. The accumulated depreciation account is an odd kind of account. It is what's called a contra asset account. It belongs with the assets, but the debit credit rules are different for accumulated depreciation as compared to other assets. Accumulated depreciation increases with a credit. Now the accumulated depreciation account is used to, on a year-to-year basis, you keep up with the total depreciation you've taken on the asset that relates to. So if it's the equipment account, this balance in accumulated depreciation will show you to date, all the prior years and the current year after you make this entry, how much depreciation has been taken on that equipment. And of course, you should know by now that depreciation is the writing off of the cost of the long-term asset over its useful life. So if the equipment will last you, let's say 7 years, you will take the cost of the equipment and expense it off over the 7-year period. Let's look at another example of an adjusting entry. Entry number 2. Let's say that when the year end cuts off, so here we are on December 31st, and you find out that you have some employees who've worked for you for the last several days, but payday is not until on into January, so let's say January 3rd or 4th. You need to record the fact that these people have worked for you for the year that's ending, so you have an additional salaries expense, and also record the fact that you owe them the money. And we're going to use an account called salaries payable. So don't credit cash on this. You're not paying them yet, not at the end of the year. You'll pay them on the next regular payday, which, as I said, might be January 3rd or 4th, or whenever it happens to be. The entry would be to debit salaries expense, and let's say that was $800, and let's credit salaries payable, $800. So, salaries payable is just like any other liability. It's a short-term liability in this case. It represents the fact that you owe your employees some money. And you will pay this on the very next payday. Salaries expense is used here, as I said earlier, because these people have worked for you in this year that's ending, and you're trying to, with these adjusting entries, get everything up to date on exactly what has happened in this accounting period. Another entry, adjusting entry, let's say that you receive a utility bill, and you received it December 30th, and the utility companies usually give us maybe 10 days or 2 weeks to pay it. So you receive the bill, it's for December, so you use the utilities in December, you owe the money. So with this adjusting entry, you're going to record these two facts. So utilities expense, to get the expense recorded, let's say this was $2,000, and then utilities payable, $2,000. So again, you're recording exactly where things stand. You have this bill, you've used the utilities, and you owe the money. And you'll pay it, again, within 2 weeks probably, but you do owe the money. So as of December 31st, you had this expense that belongs in this year, and you do owe for the utilities. Another example of an adjusting entry is, let's say, supplies. So when you purchase supplies during the year, you record that in the supplies account, which is an asset account. When you use the supplies, we'll need to expense that off sooner or later, the part you've used. So we're down here at the end of the year. What you will do is take an inventory, in other words, count the supplies you have not used. So for example, if you purchased $10,000 of office supplies during the year, you have like $10,000 sitting in your supplies account as a debit. And let's say you've used $9,000 of those supplies. What you will do is debit supplies expense to show you've used up $9,000 worth. And then you will credit the supplies account. This entry is showing you that you've used $9,000 of these supplies, and the example I gave you, you purchased $10,000 during the year, and you always recorded that in the supplies account, which is an asset account. Now you find out at the end of the year, you've used $9,000 of these supplies, so you need to show the part you've used as an expense. That's why we debit supplies expense and credit the supplies account, and the supplies account is an asset account. Another adjusting entry would be, for example, when you've done work for some clients and they've not paid you yet. You haven't recorded anything as to date. Maybe you're not finished with the job, but you're partially finished. So our entry number 5 would record the fact you've done some work for your clients and they owe you the money. So we would debit accounts receivable, let's say that was $4,000. And then let's credit service revenue. There we go, $4,000. Okay. This shows the fact that as of December 31st, you've performed services for your clients in the amount of $4,000 that you have not entered in the books yet. That's why you're doing it with this adjusting entry. They owe you the money. That's the accounts receivable part of this. And you remember, the accounts receivable account shows how much your customers or clients owe you. You also show with the service revenue credit that you have earned this. You've done the work this year and you've earned this amount of money. Another example would be number 6 here. If you remember in your studies, you probably saw where sometimes customers pay you in advance. So if they pay you in advance for a service, then you owe them either the service or you owe them the money back. So the original entry you might have made like a month or 2 ago would be to debit your cash account when you collected the cash in advance, and then the credit would be to either deferred revenue, or that's also called unearned revenue. I'm not going to show you that here because that's not an adjusting entry, but that's the entry you made earlier. Again, debit cash, and then you credit deferred revenue, or sometimes called unearned revenue. And that deferred revenue account is a liability account. What you need to determine at the end of the year is how much of that have you provided so far as a service. And that's the part you don't owe anymore. We're going to reduce the liability. And also that's the part that you've earned so far and record that as revenue. So with that explanation, what you'll do is debit the deferred revenue account, and this is a liability account that you're now reducing with this debit. Let's say this was $1,000. And now let's credit service revenue for $1,000. Once again, this entry is to show that for the customers you paid in advance, that paid you in advance, you've now earned part of this. So you'll have to determine at the end of the year how much of the work you've done and record that with an entry just like this. So this, again, this debit to deferred revenue, which is a liability account, is to reduce the liability account because you don't owe them this part anymore. And you show the fact that you have recorded revenue, you've earned this revenue, so you need to get it recorded in this year that's ending. Okay, so those are some examples of some adjusting entries, and again, these are prepared at the end of the accounting period, and the main reason is to bring all the accounting records up to date. A good number of entries will be made. There could be numerous accounts that need to be adjusted. There are a few that are never adjusted, but you will have some that are adjusted. So anyway, that's a quick review of adjusting entries, so good luck with your studies.